Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Stocks in Asia slump while futures point to another day of losses as traders hold fire ahead of today's delayed data on the US labour market. President Trump says a deal to end the war in Ukraine is closer than ever. But President Zelenskiy makes clear that territory remains a key disagreement. Plus, UK jobs data forecast to show rising unemployment 2 days ahead of this week's rate decision from the Bank of England. So it is a rough setup to the market open in Europe and in the US as well. The Asian stocks have been battered near correction territory, near bear market territory for the tech index over in Hong Kong. We'll unpack that for you shortly. European futures then, pointing lower by 0.7%, looking to wipe out all of the gains that came through yesterday for the European equity space, where you did see upside of 7 cents, a different picture versus their US counterparts. FTSE 100 futures in focus as we lead up to the data in terms of jobs and unemployment here in the UK this morning. FTSE 100 futures currently pointing low by 0.4%. S&P E-minis after losses of about 0.2% yesterday, pointing low by 0.6 today. And Nasdaq 100 futures looking to drop 232 points. The anxiety around tech and AI as a theme continues, but the data out of the US later today could, of course, change the momentum in terms of how things are feeding in to these various different asset classes. Talking of which, 416 right now in the US benchmark 10-year, largely unchanged on that benchmark. The pound in focus, again, around the data points that started around 7 a.m. UK time, 133 right now. The dollar, by the way, at around the lowest level in about 2 months. That's not doing much for the pound in the session today. Bitcoin at 86,000. Continued weakness, of course. Don't forget that just back in October, you were above 120,000 for the Bitcoin story. Currently down 0.2%. Brent crude at around the lowest levels, oil prices since 2021. $60 on Brent, down 0.7%. Let's cross over to Winnie Su, standing by right now in Tokyo for a check on the Asian markets, where the session has been challenged indeed. Winnie.
Yeah, morning, Tom. Indeed, it is really just red. It's pretty much a sea of red here in Asia. You can see that the benchmark here, MSCI Asia, along with all these other key indexes in the region, down more than 1%. And yes, it is a bit of a risk-off mood ahead of the U.S. jobs data, and especially with how we're seeing this rotation away from technology shares still unfolding. And specifically in Japan, we are still waiting for that Bank of Japan its policy decision later this week. And for now, expectations baking in for a rate hike, which is going to take rates to its highest level in about 3 decades. And hence, you are seeing a bit more strength with the Japanese yen here breaking through that 155 level against the dollar. However, you know, it is an overall weakness in Asia, but specifically, as you highlighted, these Hong Kong listed Chinese shares. As we flip the board and take a look at how we are looking for these milestones, we are talking about, for example, MSCI China and HSCI entering that technical correction level. But specifically, we are also watching HS Tech here close to that bear territory, which means it's down about 20% since its October high, and also taking the level to about the level around the Liberation Day. So it really is a bit of kind of the rally faltering here, especially with these key data missing expectations. And hence, we're still seeing a lot of concerns when it comes to the sluggish economy, and especially when we don't have as much support from the government's policy stimulus. Now, sticking with China, we also want to take a look at what's going on in the currency space. As we flip the board and take a look at the Chinese yuan, yes, it has been really strengthening this year, strengthening about 4% so far against the US dollar. And actually today it's strengthening for a 4th day. So we've been hearing from these reports saying that these top economists in China, some of them being former central bankers, trying to encourage the government to further strengthen the yuan in order to support the growth of the economy. Back to you, Tom.
Winnie Sue in Tokyo, thank you. With the market update, of course, and a brutal session over in Asia, a focus on both the yuan and the yen as we lead up to the BOJ decision, of course, on Friday. And an update there. Now, to geopolitics. After 2 days of intense negotiation in Berlin, US, European and Ukrainian negotiators suggest major progress has been made in finding an agreement that would end Russia's war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Well, the steps forward centred around US-backed security guarantees for Ukraine. And while President Volodymyr Zelensky praised the progress, he also underlined the distance that still remains on one crucial issue.
Of course, not all aspects are simple. There are complicated things, in particular the topic of territories. Undoubtedly, everyone is raising this topic, and it's important that we all work to ensure that things like that are absolutely fair. We had enough of dialogue about territories. I think that so far we have different positions. I'll be honest, but I think that American colleagues have heard my personal position, and I'm very happy that I was able to personally convey this position.
Let's bring in at this point Bloomberg's chief Europe correspondent Oliver Crook. Ollie, then a lot of positive sounding rhetoric. What underscores that? What happened in these negotiations?
Yeah, very positive rhetoric indeed. I mean, Trump's saying that they're closer than they have ever been to a peace agreement in Ukraine. I mean, we can also say, Tom, that we've never really ever been close, so it may not be saying a whole lot. But according to some of the sources that we spoke to on the U.S. side of those negotiations, they said that consensus was reached on about 90% of the points of this peace agreement between the Ukrainians and the Americans. This, of course, then needs to go to Moscow. What it centers around the optimism that is about these U.S.-backed security guarantees, and this is the term we keep hearing, these NATO Article 5-like guarantees. Now, no one has ever defined what an Article 5-like guarantee is, but of course the premise is that an invasion on Ukraine would be viewed as sort of potentially an invasion light on the rest of the NATO alliance, and as a consequence, the NATO alliance would come to the rescue of Ukraine in some way or another. This would not give Ukraine full NATO membership. It would not give them a seat at the table. It would also probably put, and we're speculating here somewhat, an impediment in terms of the sort of free movement of NATO troops and weaponry into Ukraine, which is, of course, the sort of red line for the Russians, which they really see NATO incursion as a sort of instigating factor of this war. But that's the sort of positive side of it. Of course, there's still this major question on territorial boundaries. The Russians said they don't want to engage in any kind of discussion about ceasefires or ceasing any kind of hostilities until the entirety of the Donbass has been sort of either surrendered or in some ways been part of this framework, and that has not yet happened, Tom. And this is, we should say, as the Europeans get more positive about progress on this deal, the Ukrainians get more positive on progress of this deal. We have not heard from the Russian side yet, and the more positive the Ukrainians and the Europeans are, presumably the less positive the Russians will be. So we're going to have to wait to see what they have to say after these days of negotiations in Berlin.
Yeah, that's crucial, isn't it, Ollie? And you have to question where the pressure is. You can see the US pressure on Ukraine at this point. Where is the US pressure on Russia? And what else, Ollie, do we know about this 20-point plan?
Yeah, as for the additional pressure on Russia, we should say that there were those significant sanctions that were put in place only a couple of weeks ago, Tom, on Lukoil and Rosneft, which does have a major effect on the Russian economy, though it's not something, as you rightly point out, that the Americans have really been trumpeting or trying to put additional pressure on. There are, of course, many other sanction barriers that the U.S. could address, but we also got a little bit more of a readout from the European side here. This is a statement that was signed by the leaders of France, UK, Denmark, Sweden, Finland, Netherlands, Poland, Italy, after those talks in Berlin yesterday, saying that another parts of this 20-point plan and what they could include. Among them would say that the Ukrainian armed forces, which should remain at a peacetime level of 800,000 troops. Remember, the initial plan of 28-point plan asked for a reduction in the size of the Ukrainian military to 600,000, that there would be also a, quote, multinational force Ukraine made up of contributions from willing nations, the coalition of the willing framework, that would also potentially include operating within Ukraine. A ceasefire monitoring sort of system that would be led by the United States, and a legally binding commitment to take measures to restore peace and security in the case of a future armed attack. These measures may also include armed forces. So these are some of these sort of details, it seems, that the Europeans are trying to put into the security framework going forward. We should also say that there was a clause about reconstruction and what should happen in terms of compensation from the Russian side to the Ukrainians. This, of course, Tom, as you know, is the sort of major issue that is in focus for Europeans this week. Those Russian assets, whether or not they will move to seize those or monetize them in some way to get a loan to Ukraine. And that is something we're going to have to wait till Thursday to find out if European leaders can make progress on that point.
OK, Bloomberg's chief Europe correspondent Oliver Crook with that update. Ollie, thank you. Now to the macro picture on the global economy with a particular lens, of course, on the US. Of all the data out this week, today's delayed US jobs report is the most closely watched. Let's bring in Bloomberg's Valerie Teitel. Val, what are we expecting then?
Essentially a lot of noise, Tom. Even so much noise that the Bureau of Labor Statistics released a 9-question frequently asked question press release on their website yesterday, saying that the household survey has higher statistical variance than previous surveys, and they expect this kind of errors, these standard errors, to persist for a few months after November. So that with that backdrop, though, so we have to take everything we get today, at least with a grain of salt, that it's likely to have been warped by the fact that we did have that government shutdown, the lapse in data collection, and the fact that the November jobs data was taken a week later than is normally collected. So that adds, confusion to the seasonal patterns and all that jazz. But the interesting thing to see is that the consensus estimate at the moment is for a 50K jobs addition for the month of November. We are also going to get the payroll number for October. It's going to be released on the eco screen as the bucket under prior. So have an eye on that, too. So look at the prior reading and today's reading for November. Those taken together is the total amount of jobs added to the U.S. economy over the last 2 months. The whisper number is quite a lot lower. It's around 20K, Tom, but our own Anna Wong and our Bloomberg economics team actually thinks that the November number could be the largest since Liberation Day, essentially. 130K is what she is going for. So a lot of estimates all over the place. It does seem like Wall Street is a bit more pessimistic on what we could see today. I would also have a keen eye on the unemployment rate. It is expected to tick up to 4.5%. Now, the backdrop to the unemployment rate is that it has been rising every month by 0.1% in the last 3 readings. We obviously skipped the October reading. So there is quite some room for an upside surprise on the unemployment rate. And I think Powell has dragged our attention to this a little bit more in the press conference last week. He mentioned that he expected the unemployment rate to only tick up by 1 or 2 more tenths in this cycle. So if you get an upside reading, maybe the unemployment rate ticking from 4.4 to 4.6, I think that would really start to doubt the Fed's confidence that the labor market at least is beginning to accelerate its loosening in the U.S.
That's really, so our own team of economists see 130,000.
A pretty decent reading for the year.
Yeah, OK. So and that could lead to a fading out of rate cut bets then in 2026. Chera Chanana of Saxo Bank telling us yesterday that she thinks anything between 50,000 and 100 at 50,000 and 0 is probably positive in terms of pricing in additional cuts. Anything below 0, when you get in negative territory, she thinks that would lead to concerns about the economy and a different reaction then and a sell-off in equities. When it comes to the NASDAQ, there's some changes afoot. So we're going to switch focus a little bit. And that was a really helpful setup in terms of the data we're getting later today. The NASDAQ seeking approval. How do we trade this? 23 hours, not 24. 1 hour break for the NASDAQ. That's what they're looking for.
Exactly. So the break will be in between 8 p.m. Eastern and 9 p.m. Eastern if this goes ahead with approval from the SEC. The NASDAQ will essentially classify this trading time as the night session. So it'll go alongside the pre-market and the aftermarket and the normal trading hours, essentially putting single stocks on a 23-hour trading schedule, which is essentially what we have for U.S. equity futures. When we talk about S&P E-minis, NASDAQ futures, those trade on a 23-hour schedule. Now, the NASDAQ is looking to do this because foreign demand for U.S. stocks has hit a peak, essentially. They own around 30% of the U.S. equity market. Some of these investors are based in Asia. It's hard for them to access the liquid trading hours of the NASDAQ. And obviously, since the pandemic, these extended trading hours have become more popular, especially with those apps like Robinhood. You have retail traders who have been given access to alternative exchanges, which do allow them these extended type of 24-hour trading schedules. Now, the concerns are that during these lower liquidity trading sessions, during this night trading sessions, it'll essentially won't give investors a lot of time to digest earnings, after hours headlines, and could lead to heightened volatility in those more illiquid sessions. But again, Tom, we've seen from the likes of companies around the world really wanting to move their listing to the U.S. to access the more liquid markets. The most recent one was SK Hynix, the South Korean chip maker, wanting to have an also dual listing in the U.S. because it increases their valuation. So this could really be something that could draw global tech companies away from their home market and to the U.S. Okay. And we know that the U.K. at least has been suffering from that kind of dual listing.
Yeah, indeed. So another potential competitive edge for UK indexes and the Nasdaq. Thank you, Valerie Teitel. We'll see if that gets approval, of course. Here's what else to think about today. Then 7 a.m. UK time. We touched on this UK employment data coming through. Consequential, of course, ahead of the Bank of England's decision on Thursday. And from 8:15 a.m. we're going to get flash PMIs for the UK as well. 1:30 p.m. UK time, the delayed US November jobs report that Valerie was setting us up for. And so you now know what to look for when it comes to that data, with all the caveats around the potential murkiness of that data print. Coming up, gold on track for its best year since 1979. We're going to look at the prospects for the yellow metal in 2026. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, gold ticking lower today after a 5-day rally as investors wait on today's delayed US jobs report. The yellow metal has surged more than 60% this year and is on track for its best annual performance since 1979. Joining me now is Bloomberg's metals and mining reporter Jack Ryan for a perspective on this and looking into 2026 as well. Jack, how would you follow this obviously at a granular level? How would you sum up the year in gold?
It's been a remarkable year. It's kind of been one of those periods of time when gold, I think, has managed to punch its way into the mainstream of kind of the debate in financial markets. And I think that has been mostly just a reflection of its price. It's up about 63% now, something like that, which, as you say, is its best year since 1979. And then I think, as well as that, I think it's been what's driving it. And there's been all of these various developments coming out of the White House, for example, which have been kind of bullish drivers for gold. And that has pushed it into the headlines in a way that it hasn't been for years, I think, maybe since the 1970s. So
talk to us about what's been coming out of the White House and some of the other catalysts, whether it's central bank buying or ETF flows, and what has been underpinning this pretty remarkable rally that we've seen.
Well, there's a lot of kind of buyers that you could point to. You could point to, obviously, the ETFs. This is really the year when the ETFs came back. So usually it's kind of a pro-cyclical thing. The gold price goes up and investors buy ETFs, which is unusual, but they buy in when the price is higher. That hadn't been the case through 2024. There'd been continuous outflows. There'd been investors taking profits even as the price rallied through 2024. And then this year was when the two lined up. Investors were piling into ETFs and the price was rallying. So they bought more than 500 tons this year, which is a big addition when you look at the margin. And so that's been, I think, a really important driver of the price. Then obviously we have central banks. This is the big story with gold, that really this is something that they've been buying. They've been net buyers since the global financial crisis. And it's been since 2022 when that buying has really ramped up to about 1,000 tons a year, up from about 500 tons a year. And that, again, has been a really important addition at the margin, which has kind of supported prices. And they tend to be quite price inelastic in their purchasing habits. So that's quite a useful driver for the price, as it maybe doesn't tend to be as, it doesn't contribute to volatility in the same way. And then you look at why they've been buying. There's many different reasons, but I think most of them come down to the new administration. I think one of my colleagues said the other day, gold loves Trump. There's been, earlier this year, we had Liberation Day. People were talking about the Mar-a-Lago Accord. More recently, there's been all these narratives, the debasement trade, all this kind of stuff.
Well, he's put half of it in the White House, hasn't he, as well?
Yes, exactly. Yeah. Maybe that's what's been driving gold higher. Yeah.
Hey, Jack, what's the outlook then for 2026? I've seen targets of 5,000. We're at just below $4,300 per troy ounce for gold right now. I've seen people coming out confidently saying we're going to get to 5,000 by the end of 2026. What is the outlook? What are you seeing when you speak to analysts and those in the space?
I think Goldman Sachs had a really interesting note the other day. They're calling for 4,900 by the end of next year. They've been kind of quite consistently bullish. One of the things they identified, which I think is an interesting theme, is if you look at in the portfolios of private US investors, how much of their portfolios of equities and bonds are in gold. Actually, it's a really tiny amount. It's less than 1/5%. And so they've identified, they think that a 1 basis point increase in that share gets you a 1.4% increase in the gold price. And it still is really marginal. So I guess an important part of that is if these narratives set in about the debasement trade, maybe you feel less safe holding treasuries, you're worried about the purchasing power of your dollar, and you don't see many good ways to hedge that. If that really sinks in with US retail investors, this vast amount of wealth that's held in private portfolios in the US, that could be a really important driver of the gold price going into next year. And that's one of the bullish factors they identified.
OK, so watch for the debasement trade. Jack Ryan, thank you very much indeed, breaking down the year that was almost for gold and the look ahead. What could some of the key catalysts could be for the alloy metal in 2026 as well. Currently just below $4,300 per troy ounce. Coming up to the auto sector, Ford reversing on its EV strategy in a move that will cost it close to $20 billion. We bring you the details next. This is Bloomberg. Welcome back. Ford will take a $19.5 billion in charges tied to a sweeping overhaul of its EV business after struggling for years to make it profitable. The CEO, Jim Farley, says the overhaul is about moving towards more profitable vehicles.
Look, for this announcement, Matt, it's really about moving to more profitable vehicles. We're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know, not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, those are really profitable vehicles for us.
Meanwhile, the US military has attacked 3 more alleged drug boats in international waters in the Eastern Pacific, killing 8 people. In a post on social media, the US Southern Command said the strikes were carried out at the direction of Defense Secretary Pete Hegseth. Donald Trump has cited fentanyl deaths in the US to justify the attacks. The US president now says he's reclassifying the drug as a weapon of mass destruction. Australian authorities say homemade Islamic State flags were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration on Sunday. At least 15 people were killed in the terror attack. As more details on the father and son gunman emerge, officials in Manila say the pair travelled last month to an area of the Philippines where Islamic State-aligned groups have operated. Coming up, UK jobs data out later today is expected to show a rise in unemployment and slowing wage growth. We're going to be discussing that in depth. We'll set you up with a preview. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks in Asia slump while futures point to another day of losses as traders hold fire ahead of today's delayed data on the US labour market. President Trump says a deal to end the war in Ukraine is closer than ever, but President Zelenskiy makes clear that territory remains a key disagreement. Plus, UK jobs data forecast to show rising unemployment 2 days ahead of this week's rate decision from the Bank of England. Let's get to the markets then. Risk off is the sentiment. Certainly, you look at the session in Asia, it has been brutal. Losses on Wall Street with the Nasdaq closing lower by 0.6%, the S&P down by 0.2% and looking to build on the losses today. European futures down 0.6%, so almost entirely wiping out the gains that came through for European stocks yesterday. The FTSE 100 in focus as we lead up to the data that starts dropping at 7 a.m. UK time, currently pointing lower by 0.4%. The FTSE 100 has outperformed its US counterpart and European counterparts year to date with gains of around 18%. S&P E-mini is down 0.6%, and Nasdaq 100 futures looking to a challenge session as well, pointing lower by 228 points. Let's flip the board and have a look cross-asset. Treasuries are relatively stable. That could, of course, adjust around the non-farm payroll data for October and November, dropping later today. The 10-year yielding 4.16. The pound in focus ahead of the UK data, 133 right now. We'll get a clearer picture then on jobs and wages shortly. And Bitcoin at around 86,000, just up 0.2%, but continuing to be under pressure. The original cryptocurrency, of course. Brent at $60 a barrel, down 0.6%, and at around the lowest levels now since 2021 in terms of oil prices. Let's get to the UK then. A raft of UK economic data out this week, including jobs data today, expected to show a rise in unemployment. To dig deeper, let's bring Kit Rees, co-editor of Bloomberg Markets today, joining me around the desk. Kit, any surprises expected out of this week's data?
I mean, there's always scope for surprises with UK data. One thing that's really important to note is that there have been a lot of data qualities with the ONS this year. So, we'll be looking if there's any revisions. One particular number that we'll be honing in on will be the payroll figures. This is a very volatile number, and we're expecting to see 20,000 jobs lost. This could be revised on in the next batch of data. So it's a really, really key week. We've got jobs data. We'll be watching wage growth, unemployment. I mean, judging by what happened last time, the unemployment figure massively surprised, and unemployment reached the highest level since early 2021, which sent bond yields plunging as people ramped up bets on a Bank of England rate hike. So any kind of surprise, it could rattle markets a little bit. And, coupled with the inflation data due on Wednesday, we're going to be looking at, what picture this paints of the UK economy and whether this indeed bolsters the case for a rate hike from the Bank of England late in the week. So a lot to get through indeed. But
so how fragile is this UK economy? Are we closing in on a quarter of contraction now? The growth numbers have not been positive. They've been surprised at the downside. We'll get additional data, of course, through this week to your point. But as things stand, how fragile is this economy?
Well, I'm going to try and be a little bit of an optimist and say things aren't great. They are quite weak, but we're probably going to be heading in the right direction. So if wage growth cools, it means that hopefully the tax hikes we had earlier in the year have filtered through now and businesses have adjusted their costs. And if unemployment rises, then, we have a weak labour market, but businesses are adjusting and hopefully the Bank of England could cut rates, which would be helpful, for households, lower borrowing costs and so forth. So obviously inflation will be the really big one. We want to see that downtrend continuing. That's what the Monetary Policy Committee will be wanting to see too. If there's any surprises there, that could kind of put a span in the works, but hopefully we're heading in the right direction.
OK, so particularly close watch on inflation data out on Wednesday ahead of the BOE's decision, of course. Thank you very much, Kit, with an update and a preview of the data coming through from the UK starting at 7 a.m. UK time. We'll break that live for you, of course, in a little under 30 minutes' time. Kit Rees, co-editor of Bloomberg Markets today. Let's get a closer look on the UK with a particular lens on the UK equity space as well in terms of how to think about positioning into 2026 and bring in Tineke Fricke, head of UK equity research at W1M. Tineke, thank you for your time. Let's start on the macro picture then, and then we'll get your views on the equity story here in the UK. What expectations are you making about the pace of rate cuts that the BOE could push through, not just this year, but into 2026? Do you assume that Thursday is done and dusted, and then how many do you make an assumption for into 2026?
So yes, it's assumed that we're going to see a 25 basis point cut on Thursday. So that that's kind of probably a given. But as Kit said, what we would be looking at, is the wage inflation coming down faster, for example, than we expect, which is good overall for the inflation picture and gives the Bank of England more room maybe to cut faster. But obviously the employment number is also important. So if unemployment doesn't really rise that much, that maybe the economy does a bit better than expected. So it's a real balancing act. But overall, at the moment, the expectation is that we're going to get another 3 cuts in 2026. So we will end up around 3% interest rates next year. The timing of that, when we will get there, really just depends on how particularly inflation data evolves.
OK, but you're looking potentially at 3 cuts in 2026. How supportive would that backdrop be then for stocks?
It all depends on how the economy fares, because obviously rates get cut because the economy is struggling a little bit. But by and large, as you touched on earlier, we have in the UK a lot of companies that are focused on the domestic economy. And generally, if business can be done cheaper because borrowing rates are lower, you should be able to see more activity. So that should be good for that part of the world. But obviously, if unemployment spirals and economic growth slows even more, that's less good. So, the Goldilocks is ideal, that it's just slowing a little bit and we can all do a bit more. What will be interesting, actually, because what we are hearing is that a lot of companies have been a bit cautious ahead of the budget. So it'd be interesting to see the December and the January stats to see if you get unleashed spending, which will be lovely. OK,
yeah, we'll see if that happens. So there is a divergence when it comes to the domestic-focused index, the FTSE 250, up about 5% year-to-date versus 18% the gains for the FTSE 100. That has outperformed the S&P 500. No tech, essentially, but the FTSE 100 has outperformed the S&P 500. How does that story, do you think, evolve in 2026?
It all depends a little bit. So what has really helped the FTSE 100 were UK banks, domestic banks, and generally when interest rates sort of rise, they do quite well, but they've done quite well in improving profitability. I think that will continue even in the rate cut environment. The other bit was the defence names. And obviously we have to see what happens in Ukraine there, if they will have another bumpy year. The FTSE 250 have a lot of domestic names, and it really depends on what the consumer does, because consumer confidence is low, but savings ratios are very high. So there's a lot of money to spend. So if they spend more, we could see a better performance from the FTSE 250.
Do you have preferred sectors at this point as you look into 2026 in terms of how the advice or the research you're putting out there to your team in terms of how to position their portfolios?
So we tend to really focus on areas where we think sentiment has just become too negative. So we started to see a bit of a pickup in healthcare. Healthcare has been very weak on the back of moves from the US government. That's starting to move a little bit. But also anything in the consumer space, actually globally, in consumer staples, so food and personal care products, but also some discretionary. So if the consumer sentiment improves a bit because cost of living looks a bit better, that would be an interesting area to look at.
So healthcare and consumer. What's the IPO pipeline looking like for next year?
So according to the London Stock Exchange, it's looking good. We obviously saw some new names that might join. So RAC might be the latest one. The AA sounds like maybe they're trying to sell somewhere else. But we're hearing more names that are looking to IPO in the UK market, and hopefully some of the recent relaxations of the listing requirements help a bit. Obviously, we have a delay in stamp duty, so hopefully that helps as well. So we're looking forward to 2026 being, a richer year in IPOs than last year.
With your view that we could be getting three additional cuts from the Bank of England in 2026, how does that tie into your views around sterling? We assume a weaker pound then in that scenario.
That's right, because obviously the UK comes from a relatively high rate, but the pace of rate cuts in the UK is probably the highest. So yes, you would expect some weaker sterling, but it depends what other countries do as well.
Yes. Does that derail foreign flows into UK stocks? I mean, they've been pretty minimal anyway, haven't they? But weaker sterling kind of off-putting any international exposure to UK equities. How much of a headwind could that be?
It's a headwind as well as a tailwind. So for international companies that make more money outside the UK, a weaker sterling, a trend, they make more sales. So that's another argument for some international names, for example. But if you have UK domestic companies that buy everything in dollars, for example, that's more expensive than if you have. So it all depends, and there's hedging in place for a lot of companies.
OK, Tineke, thank you very much indeed with a view on how to think about the UK stock space as we count down, of course, the Bank of England's decision on Thursday, expected, of course, to cut. Tineke seeing maybe 3 additional cuts through 2026 with a focus on healthcare and the consumer space, maybe some upside to come through there next year when it comes to the UK equity story. Tineke Fricke, head of UK equity research at W1M. Meanwhile, on the defence space, and this is something that Tineke brought up in terms of what has been driving the gains for the FTSE 100 this year, banks and defence. Well, over in Germany, Rheinmetall is called lower, falling 4.6% on Tradegate versus its close. Rent Group also under pressure, falling 5.6%. This no doubt tied to the positive rhetoric when it comes to a potential peace deal between Ukraine and Russia. One major hurdle, of course, to get over is Russia's agreement, of course. But so far, the reaction on those defence names that have rallied this year is negative on the back of improvements around the rhetoric on that potential deal. Those are stocks to watch at 8 a.m. UK time. Now, some other stories making the news this Tuesday. The UK has finalised a free trade deal with South Korea that London says will boost exports to the Asian market. The agreement comes just weeks before an earlier agreement was set to expire. The UK says the deal will grow services exports by more than $500 million as firms get improved access to Korea's financial market. The Financial Times, meanwhile, is reporting that the US has suspended implementation of a technology deal it struck with the UK during Donald Trump's state visit to Britain. Citing sources, the paper says US officials are frustrated with the UK's lack of willingness to address so-called non-tariff barriers, including rules and regulations governing food and industrial goods. That tech deal, of course, was much trumpeted on Trump's visit to the UK. Meanwhile, President Trump is suing the BBC for $10 billion over a misleading edit in a documentary last year. The clip gave the impression he had made a direct call for violence in a speech leading up to the January the 6th, 2021 attack on the US Capitol. The BBC previously apologised for the edit but has rejected Trump's demand for compensation. Earlier, we said the amount that Trump was suing the BBC for was $5 billion. To clarify, that is the amount he is seeking for his defamation suit. The total value he's suing the BBC for is, in fact, $10 billion. The EU's top trade official says China has started granting long-term licenses to rare earths, allowing access to the critical minerals needed for industries including clean tech, autos and defence. Maros Sechikovic has been speaking exclusively to Bloomberg.
I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of a, I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
Coming up, the Saudi sisters with a $50 billion family fortune, giving them influence from Riyadh to Wall Street. More on today's Bloomberg Big Take. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, one of Saudi Arabia's most powerful business dynasties is stepping further onto the global stage. Today's Bloomberg Big Take looks inside the Olayan empire, which sisters Lubna and Hutam have transformed into a $50 billion force, with influence stretching from Wall Street to Riyadh. For more, we're joined by Bloomberg's Abir Abu Amar with the details on the reporting around this. Abir, how significant then is the Olayan family's influence?
Good morning, Tom. So perhaps the way to show their influence is the way we set out into the story from this morning, and it's about the banquet that President Donald Trump had thrown to Crown Prince Mohammed bin Salman when he visited Washington, D.C. In November in the White House. Lubna, who's the chair of the Olayan Group, was sat next to the world's richest man, Elon Musk. And that just shows how influential she is as a woman operating in Saudi Arabia to one of the biggest conglomerates in the kingdom. She's not a lot of women had attended that official delegation. She was one of them. But let me run you through some of the numbers, Tom, and perhaps they tell the influence as well. So the Olayan Group holds in U.S. stocks about $13 billion. Now, in comparison to the Saudi Sovereign Wealth Fund, the PIF, which holds $19 billion in its U.S. stock portfolio, that just shows you that the Olayan Group operates as a sovereign level. They hold about $1 billion in BlackRock, about 1.5 in JP Morgan, some in Alphabet, some in Microsoft. Domestically, they invest quite a bit in real estate. As a matter of fact, they have a stake in ICD Brookfield, the building right across from us in Dubai, but they're also involved in PE and in listed equities in Saudi Arabia. So quite influential name in the kingdom and more so in Wall Street.
So how have they been able, how have these two sisters in an environment and in a business world, of course, typically dominated by men in Saudi Arabia, how have they managed to carve out so much influence and so much success with the business?
So you're right. I mean, they took on the business from their father, Sulaiman, who had in fact mortgaged his house in the mid of last century for $8,000 to start the Olayan Group in 1947. And they took on the business. Lubna recently became the chairperson of Olayan. Hutham is the chair of the shareholders board. And together, they actually grew up at a time in Saudi Arabia where women had to seek male guardianship to even attain a passport. So, things are obviously very different in Saudi Arabia right now, with the participation of women in the labor force increasing to over 30% over the past decade. But I remember Lubna during this year's FII in Saudi Arabia in October talking about how, some of the issues that she had faced as a woman were not very palpable to her in the kingdom. And one thing that I want to bring to the table here, Tom, is the fact that the family has kept very close ties with the Saudi royals. If you remember back in the 2017 jailings of prominent business people in Saudi Arabia, including Prince Al-Walid bin Talal at the Ritz-Carlton, some other officials and some other businessmen. The Olayan family seemed to sort of escape that. During the 2018 murder of columnist Jamal Khashoggi, Lubna came out in that year's FII and said that that killing goes against Saudi DNA. So they really have stuck very close to the Saudi royal class, and that has been quite helpful in their trajectory as a massive $50 billion conglomerate in the kingdom and across.
Okay, Bloomberg's Abir Abu Amar in Dubai with that Bloomberg Big Take. Really fascinating and worthy of your time on the terminal, of course, and on Bloomberg.com. Meanwhile, the world's richest families, this is our rich segment, our wealth segment, it seems. The world's richest families have seen their wealth surge over the past year. The 25 top dynasties added more than $350 billion to their fortunes in 2025, bringing their combined wealth to nearly $3 trillion. The founding family of Walmart, the Waltons, topped the list again with a net worth that exceeds $500 billion for the first time. And Elon Musk's wealth has reached a new high. On the back of the most recent valuation for SpaceX, the Bloomberg Billionaires Index shows Musk's worth close to $638 billion. That's after SpaceX hit a valuation of about $800 billion in an insider share sale. It's the first time an individual has been calculated to be worth more than $600 billion by Bloomberg's Wealth Index. There's a lot more coming up. Stay with us. This is Bloomberg.
There was a large bout of inflation that resulted in increasing prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that.
Federal Reserve Governor Stephen Myron, of course, once again making the case for lower interest rates. We're going to get data today that could either lean into that view or push back on that view, particularly when it comes to the labour market. We know there is a lot of tension on the FOMC on the jobs market of the US. So we're going to get the data out from October, partial data at least. This is what you will be getting. This is what you won't be getting. So you will be getting the non-farm payrolls for October, the average hourly earnings and average work week in October. You get the full print for November. That has been delayed as well. This all comes out later today. And of course, the focus on the unemployment number and the focus on whether or not you get the survey print 50,000, how much you get below that, above that, and what that means in terms of pricing around the Federal Reserve for 2026. There's a lack of clarity there, isn't there, in terms of the debate around inflation versus jobs. Markets and traders still pricing in around 2 cuts for the Fed for 2026. We'll see how that adjusts on the data of today. Talking of data, let's flip the board and have a little look at the UK jobs data. That will start dropping in the next couple of minutes. And the labour market here is looking weaker. You're expecting to get a tick up in terms of the unemployment number here in the UK to 5.1% from 5%. All of this, of course, leading up to the Bank of England's decision on Thursday. Markets almost fully pricing in a rate cut, of course, by 25 basis points. Weekly earnings seen increasing 4.4% year on year. That is down from the previous print of 4.8%. So weekly earnings expected to soften, and you expect to see a tick up in the unemployment rate. We also get inflation data out of the UK on Wednesday. Let's flip the board and have a look at what's happening in Bitcoin. Continues to be under pressure. Around 85,000, 86,000. Just think back to October when you were above 120,000 for the original cryptocurrency. There's liquidity concerns and just a softening in terms of the risk sentiment around Bitcoin. So just keep an eye on that as we continue to see Bitcoin under pressure. Now, to access and search all of these Bloomberg terminals, you can go, of course, to the website now, also the terminal chart, TV Go, on the terminal to get access to these charts. We've got an exclusive conversation, by the way, with the SocGen, or at least not SocGen, the Secretary General of the OECD. That's coming up in about 45 minutes. Later in the day, Oliver Crook is going to be speaking with the Commissioner for Enlargement, Marta Kos. And tomorrow we're going to hear from the President of Kosovo. And on Thursday, we're going to speak to EU High Representative for Foreign Affairs and Security Policy, Kaja Kallas. That is certainly one to tune in for. What is certainly worth tuning in for is the opening trade, which is up next. Stay with us. This is Bloomberg.